We are good to go. So you probably just now saw Danny jump off. And so we're today in the process of, so we're today in the process of closing a 130 unit property in Greenville, South Carolina. And so Danny is the one who handles most of that piece for us. I would say 95%, maybe a little bit more than that. And so he's going to be joining us today, we hope. He's on, and so, but every once in a while he might have to jump off because of a phone call with the attorney or whatever. And so bear with us if he's in the middle of explaining something or talking about something, he might have to jump off. So, but that's because of a closing that's happening today. So, and for those of you who might be on, who are in that project and as one of our investor partners in that project, we will be sending out an email later today once everything is finalized and we get the final go-ahead. So just stay tuned for that. And so let's go ahead and do a couple of introductions. So I know Danny's not on here right now, so I'll start off with myself, then I'll turn it over to Brandon and have him do an introduction of himself and a little bit about his background. And then we'll dive into this particular project. So I'm Dan Handford, and I am the key principal and partner for Handford Capital. And you can find more information about Handford Capital. Just go to handfordcapital.com. We're a national multifamily real estate firm, primarily focused on acquiring assets via a multifamily syndication model where we pool multiple investors into one project. So we primarily look into the southeastern markets as well as Texas, where we do Dallas, Houston, and then we're also looking in Charlotte, Raleigh, Durham, Atlanta, Orlando, and Jacksonville. And then because South Carolina is where we are located, so Brandon and I are located here in Columbia, South Carolina, and Danny is located in Charleston, South Carolina. So we are all kind of close in South Carolina. So we do look at these South Carolina markets. Greenville's a really hot market that we really like a lot. And so is Charleston, and then of course Columbia. And there's also a couple other markets in South Carolina, which was part of the Charlotte market, which is that Fort Mill, Rock Hill area in South Carolina, which pulls a lot from that Charlotte market. So that's a little bit about me. I have, or actually our group really. This year we have done a little over, after today we'll have done a little over 1,300 doors across the various deals that we've done, and have a little over 110, 120 million in our portfolio. I haven't updated the numbers yet because of all the closings we've had over the last couple of months or so, but we will be updating those numbers. So my background is that I have 5 medical offices that I own. They're non-surgical orthopedic clinics in South Carolina. They're in 5 markets in South Carolina. So we have one here in Columbia, Charleston, Greenville, Fort Mill, and the North Augusta market. And so that's where most of my background is as an entrepreneur, starting those clinics and now having them run on a passive standpoint where I have a good team, about 50 people that run those clinics, and a very solid CEO who runs those as well. And then I also have a couple other online businesses that I run that we sell all kinds of different products, either online or in person or whatever. So you can find more information about me and my wife and I's story by going to our podcast website. We have a podcast called Tough Decisions for Entrepreneurs. You can find more information by going to toughdecisions.net, or if you have an iPhone, just search on your podcast platform, Tough Decisions for Entrepreneurs, and we'll show up there. And then you can also find it on other platforms if you're an Android or you're on a Google phone or whatever. So we're on all the platforms as far as podcasts. So I will turn the mic, if you will, over to Brandon, have him do an introduction of himself, and then we will get started.
All right, good to see everyone today, or not see you, good for you to see us as you're watching. A lot of familiar names that are popping up, and glad you could join us today. Apologize in advance for my voice. It's a little bit raspy. My wife and I have had a bit of illness. She actually is home right now with pneumonia. So she's a 3rd grade teacher, and that's not been good for her. She's been sick for about 2 weeks. I'm on the recovery end of it. So keep her in.
I hope you don't get me sick.
Yeah. No, I'm past the contagious stage. But anyways, so a little bit about me for those of you who don't know. As I mentioned before, I'm originally from upstate New York. I mentioned Syracuse. I'm actually from right in between Syracuse and Rochester along, for those that are up there, along 104, Route 104, right underneath Lake Ontario. Moved down to Greenville around 97, 98 timeframe, and have been in South Carolina ever since. So I turned my back on the snow and never returned. So you guys can have the Syracuse weather. I'll go visit every once in a while, once a year. That's enough for me. So my background is construction. I was a general contractor in Greenville, which is where the property is that we're closing today. And I did that for many years, which is where I built all of my construction knowledge, obviously. But then I took that knowledge in 2008 and transferred that into the insurance industry and became an insurance adjuster for an independent firm. So I've been doing that for the past several years until recently, where I started to change my focus into real estate. So Dan and I are both at Handford Capital, as he mentioned. We do syndicated multifamily deals, and we're focused on the Southeast, like you mentioned. So what I do is go out and try to find the deals. I work with the brokers and talk with them, or they have to listen to me and go on the tours and filter the deals and send them. Really, Danny and I know Danny's not on the call right now, so I'll kind of talk a little bit about how we interact on deals. Danny and I collaborate on the front end when we get deals through and try to decide whether it's worth even going to tour. And then once we do that, then we underwrite it, and then we decide whether we're going to put an LOI on it. And then at that point, we show Dan the deal. He looks at it and scrutinizes it from a little more of an investor perspective, because that's really where he focuses on. And so he's looking at it from an investor standpoint and making sure, that it looks good from that perspective. I'm looking at it from a construction standpoint, what it's going to cost to upfit it. Danny's looking at it from a numbers perspective, because that's his thing. He likes numbers and likes data. Me, not so much. So we've been working, like Dan said, on closing this one in Greenville. Last couple of days, I was out there yesterday meeting with contractors, talking with property management, trying to get everything set to go ahead and turn these things as soon as we get the keys. So hopefully that happens quickly. But enough about me. I know Danny's not on yet. I'll turn it back over to you, Dan.
Yeah. So I think we'll let Danny. We'll save his introduction for when he jumps on. So for those of you who just joined us, Danny is in the process of helping us with our. Actually, not helping us. He's pretty much doing the close on a property that we're doing today. It's a 130-unit property in Greenville, South Carolina. So he'll be on and off the call as he's having to take phone calls and stuff like that during that closing. So I do appreciate him taking the time to be with us today, but I know he also might have to jump on and off, as needed for that particular closing. So I'm going to get it started, because I know there's some questions that we're going to have ahead of time before Danny gets on. And so the one thing I wanted to go over first is, obviously we're talking about this deal that we lost, and we all three of us are disappointed that we lost this particular project, this particular deal, because we were really looking forward to it. And we're going to go through the whole process of how we found the deal and stuff like that, and all the way down to how much hard money we were putting up day one and all that kind of good stuff. So, and all the reasons and thoughts behind it. So hopefully this will be a very informational webinar. We did a post about a week or two ago, I think, and about 2 weeks ago, about this deal and how we were in the final round and we were about to get it, and we were crossing our fingers waiting for it to come through. And it had a lot of people posting on there that we should do a webinar on it and stuff like that. And so that's what this webinar was sparked from, was your interest from the Multifamily Investor Nation group about this particular project and deal and how we did it. So I wanted to first turn it over to Brandon and have him kind of cover a little bit about how we found the deal, and then we'll answer a couple other questions along the way. And if you have questions throughout this explanation or whatever, feel free to add them if you're on Facebook to the comments box, or for those of you who are on the Zoom platform, which is actually the easiest way for us to monitor the questions, just find the Q&A box at the bottom and ask any of your questions. If you're watching this from the recording, because you weren't able to make it live, make sure that you put into the comments box on Facebook if you're on Facebook, or if you're watching this on YouTube, just go ahead and put in the comments down below the video any questions that you might have. We monitor that and answer those questions as they come through. So I will turn it over to Brandon and have him talk about how we actually found this deal.
So these deals of this size, the 300 plus or anything really over 100, you're going through a commercial broker. These are not wholesaled. You're not finding off-market deals. These are really listed through a broker. That's how you're going to get them, which is why it's important to build the relationships with the brokers. We go on a regular basis to meet with brokers and get a cup of coffee when we're in different markets, just to get to know them, put a face with a name, try to build a little bit of personal relationship with them, so we can build credibility. So we've done that on this particular deal. They've sent the deal to us.
So I want to stop you here for just a minute, because you did this whole like air quote thing, and I want you to explain a little bit, because there might be some people listening and they're not really understanding what you mean by off market. So elaborate a little bit about why you don't feel like these deals can really be truly off market.
Well, the term off market, I would liken to when you're shopping retail on Black Friday and it says clearance, right? I'm going to use the same air quotes, clearance, because, it's not really clearance. There's not really 80% off, right? So it's a marketing ploy. And a lot of times, I don't want to say all the time, but a lot of times that's the case with these. They're trying to sell a product, and the lure of off market sounds good, but off market might be they just mailed it to their top 10 groups, but they didn't send it out on their blast, right, on their first release of the listing. So that's the difference between on market, which is to everybody. It's on their website. Anybody can have access to it that has access to the website, as opposed to just sending out to 10 or 15 groups.
Yeah, and I think that's a big distinction is that you even if you think that it's completely off market, it truly is not. I mean, if you put yourself in the broker's position or even in the seller's position, to just send it off to one person when you have a list of like your top like 5 or 10 players that have been closing deals that year, you're not just going to send it to one of them. You're going to probably send them to that select group of 5 or 10 to speed that process up if you wanted to, especially as you get towards the end of the year or the end of a quarter, if somebody wants to close something up sooner than having to wait to the end of the year and have a whole other year of waiting to do taxes for the following and stuff. So it does make it easier to close it up at the end of the year. So you might see that a little bit more towards the end of the year. But I don't necessarily think you're going to get a true better deal on it, because the market cap rate is what the market cap rate is. I don't think that you're going to sit there and be able to do a true off-market negotiation back and forth. I don't think a seller is going to negotiate back and forth with that versus you save $500,000 on a deal or something like that. I don't really see that happening. So it's all going to be based off of that as well.
Right. So the numbers are going to go where the underwriting goes, which is restricted by lenders, right? If it's agency debt, you have to have certain cash flow and you have to have certain DSCR. So they know, these brokers have already underwritten this deal to know how high they can go, right? And it still qualify for the loan. So it's going to cap out at a certain point. So, they know where it sits, and they know who the players are, and they know that people are the market's hard and people want deals. So off market is not something I really see at all.
So I know, Danny, you were able to join us now, and I know it kind of happened right at the same time where you had to jump off right as we jumped on together. So I want to thank you for joining us. And I want to, before we move forward with some of the other things with Brandon, if you would him and I went back and forth and did an introduction of ourselves. So I'll have you do a quick introduction of yourself, and then we'll dive into some of the other topics we're going to talk about with this particular deal that we lost.
Sounds great. You guys, thank you for throwing this thing together and getting the Multifamily Investor Nation on board with talking about things like this that happen when you lose out on a deal. I'm Danny Randazzo, and if anybody joined in the last few minutes, go ahead and in the chat feature, let us know where you're dialing in from, just so we can know where everyone's at. We've got people from all around the world on today, so we're very excited about that. My background is in financial consulting and smaller property ownership, and really started with my own personal portfolio, and then joined forces with Dan and Brandon to kind of scale things as we really look at multifamily and specifically 150 unit plus apartment communities as the best way to scale a real estate portfolio and have the opportunities to add value. So my strength and expertise is really the numbers guy and kind of bringing that type A personality to the group, where it's, here's our timeline, here's our deliverables, here's our schedule, and let's check every single box. And, we're not going to miss one as we go through the list. So that's a little bit about me. If you all want to learn some more about me, you can go to investwithdanny.com. I've got a lot of information posted on my blog there about what we do and kind of what we're focused on. So that's a great tool and resource to use to get to know us as a group better as well. And the other piece that I'm drawing a blank here that I was going to close on, but I can't think of it. So at this point, Dan, I'm going to send it back to you to take us on.
Sure. So I think one of the things that you mentioned there is a key thing to bring up about what we're doing today, because we have a lot of people that will talk about the deals that they close, but they don't necessarily talk about the process of getting to that point of the closing. And then we don't talk about the ones that don't close, the ones that you spend 20, 30, 40 hours on, and then you get all the way down to right before the finish line of being able to get the actual contract on it or the LOI signed, and you lose it. And so I think that's one of a key distinction about what we're trying to do as well with the Multifamily Investor Nation is not just educate you on the successes, but there's lots of things that you can learn from. I don't want to necessarily call it a failure, because every time you lose a deal, you don't necessarily fail with that. There's a bunch of learning that we had that went through that entire process. I think Brandon as well as Danny would agree with that we learned a lot going through that particular process, and we're going to cover a lot of that today about what we went through. But I also, for those of you who have joined us on our Facebook group, we have a closed Facebook group that you can find at just go to facebook.com/multifamily investor nation. That's the page. The group is listed on there as well. You can join us there with the conversations after the webinar here today. But one of the things I mentioned on there is a podcast that we're going to be starting for the Multifamily Investor Nation group that's all surrounding this very topic of deals that have closed. And then we're going to also talk to people who got a deal all the way to the point where they almost they got through best and final, and they almost got the deal but didn't, and then some of the reasons behind why they didn't. And so that's how we can learn how to better ourselves as we move forward and to be able to close more deals and to be able to negotiate better and to work with the brokers, work with the sellers, and that way you can learn from that standpoint as well. So stay tuned for that. If you're interested in being put on an email list for when it first launches, you'd be the first person to know that it launches. You can shoot me an email. Just shoot me an email at dan@multifamilyinvestornation.com, and I will make sure to put you on a exclusive list to be able to hear some of the first episodes on that particular podcast. So I'm going to stop talking about everything else, and now we're going to start talking about this deal, okay? So we talked a little bit about how yes, go ahead, Danny.
I want to do one quick thing. The importance of the Multifamily Investor Nation, another aspect to that is this community and network that we need to create and cultivate as investors. There's broker groups and networking communities. There's lender broker networks and communities. And you better believe it that those people are working together. Those people are working together to better their business and better how, maybe broker compensation works out. So it's really important to be involved and to be a part of an investor community where we can work together and hopefully gain some advantages over, sales brokers, over lender brokers, and really benefit us as a multifamily investor nation. And I want to give a shout out too. I saw Pili Yarusi with Yarusi Holdings. So I hope you and the family and the new baby are doing well. And, I know we all have a good relationship with them, and I want to continue to see that grow and see this network take hold so we can all benefit.
So did you tell your wife you were doing this webinar?
She just came in from the rain outside and snuck in on us.
Clothes on, right? Hey, Caitlin.
Hey, Caitlin. Say hey to the world. She's coming by to say hello.
Okay.
And then let's jump into this project.
Oh.
Say hello.
Hello.
All right. So we've already covered the how do we find the deal, and now we're going to talk a little bit about the actual value add play that was on this particular product. So in touring this product and visiting this product, I think that that was one of the biggest things, is some of the exciting things that were happening on this property. So for confidentiality reasons, we're not going to mention the property name, but it's a 370 plus unit, $45 million plus project in Greenville, South Carolina that we bid on. And so talk a little bit about, Brandon, the value add play that was on this particular asset and what we were planning on doing with it.
Yeah, so this asset was what you would call a true value add. You don't find too many of those. It's a very nice product, well maintained, very stable, and great location. Location on this was superb. If you don't know Greenville, which most of you don't, and I understand that, but we know Greenville well. And this was located in a perfect location. And good traffic count, close to interstate access, just really, really nice. So we didn't really have to do much to the bones, and we didn't really have to do much as far as marketing was concerned. It was really just a matter of making them nicer on the inside. They were 100% plastic all the way through. So it was really easy just to go in and upfit them, modernize them to current trends or standards. If you see the lights flashing, Dan's working on some lighting over here in the background. So our value add was just to turn the interiors and to increase the rents. And this particular property was trailing the market rent comp significantly, which is unusual to find in this market, where it's stable, it's in a good location, and it's just trailing rents from comps that are right across the street and or right down the road. So we're that just made the deal that much better. And while Dan's setting up those the lights,
Talk about the comp analysis, what we did there.
Yeah, so the comp analysis, that's one thing. Somebody had made a comment on Investor Nation about CoStar. All right, and so CoStar is a good tool. It's an expensive tool. I don't know that it's worth any smaller investor or independent investor to pay for that service on your own, because it's pretty pricey. But your brokers, when you're working with them, you can ask them for those analysis. I'll oftentimes ask the brokers, hey, can you give me a 3-mile radius on two-bedroom, 3-bedroom apartments or whatever I ask for, and they'll give it to me off of their CoStar because they have the account. We also do local comp analysis, go around and visit properties, secret shopper, if you want to call it that, and also do different analysis with city data and stuff like that. So all that was good on this property. So it really wasn't a matter of that. It was just a matter of fitting them and raising rent. So it was real easy, real clean deal, real nice play on that.
So at what point during the process did you decide that you wanted to tour this property? Because obviously we're right now in the process just today of closing on this 130 unit when we did. And so obviously knowing that there's another deal in Greenville was very helpful. So at what point in this process did you decide that you wanted to move forward and move us to that next step of actually touring this property?
Well, initially, it was a bigger deal, which is fine, but it was bigger than what we were already closing. It was a whole different type of deal than what we were getting ready to close. So totally different. It wasn't a total, complete overhaul of the property. So it was a different thing, but the economies of scale just work great because we're already in the market, management-wise and location-wise. I mean, it just makes everything so much easier. Suppliers, when we're getting appliances and stuff, it's just easier that way. We can work maybe with local people to try to get those supplies. So all those things were pluses. I know the market. I know exactly where this thing was sitting, and that was a huge plus. So pretty much off the bat, I knew that I wanted to take a look at this one. And I think that on this one, Danny, correct me if I'm wrong, I think I toured this one before we did the initial underwriting.
I think you did because you were in the neighborhood already. But, you know, a good question that I want to ask you and kind of think about this, if you were working on your own as Brandon, the only person involved in the general partnership or the syndication, how would you be able to determine when your time is useful to go and tour the property? Because, you know, as we have a team, and I think the best way to be successful in large apartment communities, you have to have a team. You can't do every role yourself. And so I think it helps, you know, Brandon can kind of outsource the numbers to me to look at, to then say, hey, the numbers work. Now I'm going to go and tour it. So how, Brandon, do you decide when it's worth your time to tour it? And think of it in two parts. Number one, if you are on your own with only your time. And then number two, as you do it with us and our team today.
Yeah, so the on my own aspect of it, you know, that you're going to have to look at the numbers first, because it just doesn't make sense to drive, you know, unless you just happen to be in town. That's a whole different ballgame, but let's pretend that's not the case. You know, that you're going to have to travel to this place and take a look at it. So you want to look at the numbers. So the first thing I'm doing is contacting the broker and finding out the guidance, right? What are you expecting this to trade for? All right, so those are the terms we're using. What's it going to trade for? What's your guidance on that? And they're going to give you a per door cost, right? They just multiply that by the times amount of doors. There's your purchase price, and then you can start doing some rough underwriting. Okay, then you can figure what your cap rate is, and does it fit the market, and what's the cash flow? Because you've already got the T12 and the rent rolls and everything on the property. So you can look at that and see, and you can do it real quick. In 20 minutes, I can take a look at the property, look at comps in the area, and see what they're pulling, see what the average rents are on these by just doing a filter on the Excel sheet from the rent roll, or looking at the financials, the T12, what the averages are, and say, yeah, I'm below market rent, and these are my comps. That's good. The price per door is in the cap rate market. So yeah, that's good to go. That's if it's on my own.
I would say that one of the things that's a big distinction here with what you're talking about is you're not just sitting here going by just the offering memorandum. You know, you're not just sitting here making a decision based on that OM. And I think that's an important piece of it as well.
Oh, definitely. Yeah. So, I mean, look, brokers are out there. They're trying to make a living just like you and me are, okay? But they are selling product, and you know, it's not that there's any misinformation, but it's the information most favorable to sell the deal, right? So, you know, we won't include this comp, but we'll definitely include this comp. You know, so it's true information, but it may not be full information. So do your own research. I mean, for me, that's a given. I mean, you need to do your own pre-due diligence. But if I'm on my own, that's where we do it. And this partnership, the way we do it is I'll pull everything down. I'll put it in our collaboration platform, and I'll message Danny through that collaboration platform, and I'll say, hey, just take a look at this. Here's the comps. I'll put those documents in. Here are different aspects of the deal, and I'll usually put if I have it, the call for offers or the CFO date in there, you know, where it's located. I'll go ahead and put the guidance in there that I've already gotten from the broker. Occupancy rate, I'll put that all in the notes, and then send Danny a note to take a look at it. And he'll look at it at a high level. And Danny, why don't I let you jump in at this point and say kind of what you look for at that high level. Once I've said, hey, here's all the information, I'm going to send it over to you to say whether it's worth looking at.
Yeah, what I kind of do is take that price per door that Brandon gets from the broker of what's the estimated trading value going to be. So I take that number, whatever it is, and I kind of set that as, okay, let's assume we buy it for this highest amount. And then we'll look at the rent comps and figure out, again, so Brandon uses you know, some of the services online or the brokers to get rent comps for that area. And we'll just say, okay, what's the fair market rent? Being conservative, of course, for our 1, 2, 3, and 4 bedrooms, and any sort of premium if we're doing a value add strategy. So I've got my highest purchase price I'm probably willing to pay to be conservative. I take my conservative income, and then I look at their T12 expenses. And I know, Dan, you and I went through a webinar a while back. We did a part 1 on all of those expenses. And you guys can go to the Multifamily Investor Nation webpage to get that listing and go and listen to that webinar to look at the expenses. And I basically come up with what is our cash flow or net operating income going to be, what's a estimated debt service going to be, and what is our overall return on the project. So I run, similar to what we talked about, Dan, in part 2 of that underwriting web series, on using the quick deal analyzer to come up with returns for that project. And, you need to do this in practice. I can run the numbers in about 5 minutes to say, yes, this checks out, we need to do more due diligence, or no, this doesn't really make sense. The broker, the price per door is crazy. This purchase price is never going to make sense. And then we try to understand if we have major gaps in it. But that first 5 minutes, and because we've got experience in this, we're able to do that. So if you are just starting out or haven't bought an apartment community before, you should run the numbers on probably 100 different properties before you go in and have conversations with brokers about, putting an offer in, just so you know the numbers inside and out, how to calculate it, what your returns are going to be, and what your investor returns are going to be. So that's the step I take. I know I probably spent more than 5 minutes explaining that to you, but I can do it really quick. So when Brandon says, hey, this is a hot deal, can you look at it real quick? And then Brandon is going to check his schedule in the coming week or the next few days to drive out and see it. But before he spends a few hours to drive and tour the property, I'm going to look at the numbers really quick and say, yes, this makes sense. Let's go see how the property feels from there.
All right, so I want to stop here for just a minute and answer a couple of questions that have come through from some of the content we've already gone through. So some of you might be going, what analyzer are you using? What project? What are you actually doing? What is this quick deal analyzer that Danny is talking about? And you can go to the part 1, I believe, on our YouTube channel. You can go to multifamilyinvestornation.com. Go click on the YouTube icon. It'll bring you to our channel. And on there's a part 1 and part 2 series under underwriting, and it is the part 1. And in that video, it tells you how to get access to that quick deal analyzer. So if you go watch that video, you'll be able to figure out how to get that. The second thing I'll tell you is that we're going to be doing a webinar specifically on that deal analyzer, what he's talking about, where you can quickly analyze something very quickly initially using that quick deal analyzer in the next probably week or 2. So if you want to go watch that video to figure out how to get it, go do that, because we're only going to do it for the people who actually have that quick deal analyzer. So make sure you go check that out so we can have that webinar done for you. So and it's not anybody else's deal analyzer that somebody else put together. It's one that Danny actually put together and has used and modified for himself. So the other question here I think was directed more towards Brandon here is have you ever used Reonomy for your comp analysis?
I have not used Reonomy specifically.
I think we've tested it, haven't we?
Yeah, we've looked at it. Most of the time you can just get on We Are Apartments or Apartment Finder and just find stuff that's in the area. You can just type in, whatever city, USA, apartments, and find the ones around that and look at the photos, look at the amenities, look at what they're getting for rents. That's market rent. That's what they're asking for, right? That's a very high level comp analysis. Rentometer or rentometer, however you want to say it, that's another one. It's very quick. None of these are 100% accurate. So this is very rough just to see if I want to waste my time going to look at the property. It would be a waste of time if I didn't do this due diligence. But once we've decided that, and I go out and then I can decide to go out and take a look at the deal. You want me to go ahead and talk about when I get to the property? I know we did a webinar several weeks ago about what to look for during property tour.
I probably wouldn't go over all of that right now, just because
I'm saying you can go back to that and watch that video if you want to get some more information on that. But when I get to the property, I'm asking questions about revenue streams. Do you have washers and dryers in the units? Do you have valet trash? So I'm looking for stuff that can make money.
So let's talk specifically about this particular deal. So what kind of questions, what kind of questions did you get answers to that really kind of helped move the needle for us on this particular deal? Because I called it here on the promotional, what issues, came up during that pre-LOI due diligence process. And for those of you who haven't followed us long enough, that we call the pre-LOI due diligence, that process that you do with the property tour, walking the unit, things like that before you actually put an LOI in place. So we kind of call that the pre-LOI due diligence. So what are some of those things that you maybe found out about this? Because I know there's a couple of things on this property that we really liked, and there's a couple of things that, not too many things we didn't like.
No, there really wasn't much we didn't like on this property. We really wanted it. I'll be honest with you. It was definitely something we wanted, and you'll find out later, how much we wanted it. Again, like I was saying, I was looking for revenue streams. So I'm trying to find out what they do and do not have as far as amenities are concerned, so that I know what I can add to that property. Because if you know the market well enough, you'll know what your client's going to want. Okay, who is your renter? Who is your client? What do they want? So, this one did not have valet trash, but they had one compactor on the property. This is a bigger property. So I don't know about you, but I don't like putting my trash on the trunk of my car and driving it to a dumpster, right? Or on the back of Dan's Audi, you're just not going to want to do that. So valet trash was a very important one there. Do they have dog parks? These all have washer and dryer connections. So I was trying to find out if they had washers and dryers that they charge an amenity rent for, that they actually owned, and charged the tenants an amenity rent. They did not. So that's another revenue stream. So right there, you're talking $75 of additional revenue per unit. On that many units, that's a significant value add right there. So those were great things that we liked. The fact that we didn't have to spend any money on the exterior. The roofs were good. The property was well maintained.
One issue that I know that came up, which ended up being, I guess you would call it a good issue at the end of the day, but I won't mention which corporation it was, but there's a large corporation in Greenville, South Carolina market that basically with one of the entire buildings it was a corporate lease on that entire building. And it was a fully furnished building that this corporation leased the whole thing, right?
Yeah, and well, it was about 65 or 70 units, I think, that they had a corporate lease on, and they do all the terms on those, so we don't have to touch those. So that's almost guaranteed revenue. They use it for their intern program, and this company isn't going anywhere, so they're a staple of Greenville market. So that was a huge plus, because
it's actually a staple of the entire country.
You could say
it's a very national company, so
we felt good about that.
The reason why it was an issue, though, is because your lenders have certain requirements of, if you're in a market that has a very high military population, a lot of times the lenders will not allow you to have more than a certain percentage of your units as military personnel. You can't have a certain number of your units as corporate leases. And so we had to look at that and go, yeah, that's an issue, but let's see what the lender, if that number is okay. And usually the number is about 25%, I believe. You can't have any more than 25% as corporate leases, and you can't have more than 25% of your tenants as military as well, for obvious reasons. So sometimes you go into a market, you go, oh, this is great. It's got a great military town. There's like 60, 70% of the occupants are military, and they're not going anywhere. But the biggest thing is that military is usually very transient, and if something happens, they have to leave right away. They basically are out, and your occupancy just plummets. And so that's the reason why the lenders have certain requirements in there as well.
Right, and going back to this deal had two separate sections in it, two different vintages, which sometimes I don't like. I'd say most of the time I don't like that. I like a consistent product, right? This actually worked to our favor because it was a very nice product. The newer vintage or the later vintage was much nicer, but they didn't take it to the level that they could have to really take it to a Class A, right? So This property really created a very unique situation where we talked about, you always got to know who your buyer's going to be when you sell, right? And you want to leave what we call meat on the bones. We use a lot of air quotes today. Meat on the bones for whoever's going to buy it from you. So we don't want to renovate all the units necessarily on this deal, right? So the play here was to renovate half of phase 1, right? To update them, leave the rest classic. The other one was to renovate 100% of phase 2 to bring them up to luxury, what we call class A apartments. And so that way it expanded our customer base, right? So now we have something for everyone. And there was actually a place where we could gate off a section of the community for the luxury section and give them their own amenity set. And it was the way it was set up, it was perfect. So that was an unusual situation, but that was what made this property unique. The fact that it was trailing so much, the fact that I can have class B all the way to class A on this property, just made it great, plus where it was located.
So Danny is in the process right now of doing some things with the closing that we're doing on this 130 unit property in Greenville that has nothing to do with this topic, but I'm just telling you that's why he's not on right now. And he's kind of jumping on and off for those of you who have just joined us. One of the things that I want to pivot here to is, I have a question that came in about, capital raising. And so I think this is a good point to kind of shift a little bit of our focus on, how we structure the deal with investors and what our plan was for raising the capital for this deal. Because obviously with a 45 million plus project, you're going to be raising a good amount. And so I think on this one, it was north of about 20 million that we were raising on this project. That wasn't the exact numbers, but it was upwards to $20 million. And so, we neither one of us, all three of us, none of the three of us can just sit there and write a check for, 20 million bucks to get the deal done. And so we had a plan in place for raising that capital. So obviously we just came off of a raise where it took us 4 days to raise $2.5 million. And so obviously you can't just go, okay, it took us 4 days to do 2.5, so we'll take, maybe 60 days or however long it was to raise the rest. There was definitely a strategic plan in place for that. And so we have one thing we did. Our original plan was obviously to first go to our own investors that have invested with us in the past and send them out an email that we normally do. And I'll be doing a webinar on how we talk to our investors about our projects in the future. So I won't go into too much detail about how we structure that, but we send out a message to our investors, letting them know that there's a deal that we have in play, and that, and then of course tell them the timeline about the funding and all that kind of stuff. But we didn't send anything out before we don't send anything out to our investors until we actually have a contract on something, until we actually have a signed LOI or a signed PSA. And we don't want to be bothering our investors until we actually have something. So, but one thing we did put into place, what we did do is we reached out to our network of other syndicators that are putting deals together or that are basically helping out other syndicators to be able to raise funds. And so there's several groups out there that will help raise money for other deals, and they can do some pretty significant numbers. So we had reached out to a couple of those people and then had those numbers.
Yeah, question on that. So in light of the fact that we just came off of a raise, why is that important when it in regards to bringing on other syndicators or other capital raisers? Because you said we're going to offer it first to our investment pool, but we just went to our investor pool with a deal.
Sure.
So how is that important, or how does that play into the factor?
Sure. I mean, it plays a big factor because however many times you're actually asking for funds from your investors, there's going to be a certain point in time where they might not have any more to deploy. And so, but you also have some investors that will put a small amount in multiple deals. So it's kind of a balancing act. And so we ran the numbers on how much we felt that we could raise and how much we would need from outside syndicators that could actually come in and help us raise those funds. And so that was the original play, was to send it out to our own investors, find a couple other syndicators that we knew were high level syndicators that can bring, 3, 4, 5 million a piece from their investors, and then have that as our main capital raising efforts. Now, obviously, we had other contingency plays and contingency plans in place where we were already talking with private equity groups that would take the whole amount if we wanted to, or maybe we got 30 days into doing our capital raising and didn't get but maybe 3 or 4 million committed, and we're now stuck with another 15 to 17 million dollars to raise. We had that. We were gonna make sure we had that in place to make sure that we had to pull that trigger of doing a private equity play, we could do that as well. Now, obviously, we don't like doing the private equity plays as much because you're gonna have you're gonna lose some more of your spread from the sponsor side. You have to give up more of that equity on the entire project. But if it has to do with losing your hard money, and then we'll talk about how much we did here shortly, losing that hard money that you put up day one, and we're not talking about a hard money loan, and so we'll talk about that too. That earnest money day one going hard is what we're talking about, and so to make sure we didn't lose that, we had a lot of contingencies in place. And so another contingency, in addition to the private equity, was we were talking to crowdfunding platforms. So there's a lot of real estate crowdfunding platforms that will raise money for sponsors that need money for their deals. And most of the ones that we've talked to only do maybe a couple of $1 million a piece. There's not very many that will do a full $20 million raise. But if we can maybe use those also as our additional capital raising partners, that helps as well. And so obviously we had a lot of different things in place. And so I'll turn it over to Danny real quick, since he's now back with us, and have you. One question came in was this a 506B or C offering? So it never actually got to the point of an offering because we didn't have the actual LOI signed. So we this particular deal, we submitted an offer. It went into best and final. It took about maybe 3 or 4 days for them to let us know that we were in best and final. Mm-hmm. And then once we got into best and final, we submitted an offer into that project. We didn't go up a lot. I think we maybe went up maybe a couple $100,000 on this project.
Well, yeah, Danny, you want to add on that about our discussion about second round? I'll add a little bit before I turn it over to you about getting our initial offer in. So we all have a discussion about that. I've talked to the broker. I have a candid conversation with the brokers. I say, hey, what's going to get us in best and final, right? I'm not going to waste everybody's time on this deal if I want it. What's going to get me in that deal? So he gives me the number, and I take that number to our conversation that the three of us have for our initial LOI. So we made it to best and final. So Danny, you want to kind of go over, what the strategy is at that point?
Yeah, what we do is really evaluate the strength of the deal in terms of how can we increase the purchase price but still achieve the returns that we want. So, it's really working backwards. It's almost like a math equation that you have the answer to, right? We want our return to equal X to our investor. And so how can we achieve that return, and what's that highest price we can go up to get a return that we think our investors will want to be a part of. And so that's kind of how we evaluate it. And once we get into best and final, it's a little bit of a give and take too, on if you get an indication that the broker thinks the seller is interested in the most amount of money or the highest purchase price, or are they interested in what Dan said about a hard earnest money deposit, and should that be a small amount or should that be a really high amount? So the seller can know that either you're going to perform and close, or they're going to keep your earnest money deposit if you fail to perform. So once you're into best and final, you should only be competing against a few other offers. And so it's really kind of what can you go up to, or what are you comfortable with? And the one thing that really kind of saved us in that first best and final was not always giving your final number, right? Because what we learned is that despite there were several of us in that best and final round, it actually came back a third time for the best and final. And so we were able to have a little bit of wiggle room left, but we didn't want to jump up, a full 0.5% or 1% in terms of purchase price in that first best and final. So we had some room to still compete if it came back around a third time.
Yeah, I think that at the end of the day, one of the main reasons why we didn't get this deal, because obviously we got into best and final, and there was maybe 5 or 6 groups that were left in best and final. The original from the first offer we put in was we had $100,000 earnest money deposit. That was hard day one, correct? Or we didn't do any of the first round, didn't we?
No, first round.
We
because
didn't do
we
any.
knew we were in best and final anyways. That's why I had that conversation with the broker.
Yeah, so we knew we were going to get into best and final because of the conversation we had with the broker, and the numbers worked out very well for that particular number. And so we didn't go in, I don't think, at that number. It was around that number. So we kind of knew if we were in that range, you're going to probably get into the best and final. So getting into best and final is when we sweetened the pot a little bit for them and actually put in earnest money. And the original conversation was about how much of that earnest money deposit we were going to have go hard day one. And originally we were thinking $100,000 and increasing the offer price. And having the offer price increased. And so we still increased the offer price, but we didn't increase it as much because we decided to put in a lot more earnest money deposit up front. So the earnest money deposit that we were projecting on this one was going to be at $500,000. So we're going to put in $500,000. That was going to go hard day one. And then that got us into the best and final, if you will. So that third round of offers where it was basically our group and a REIT that was in there. And so that we kind of knew we were competing with the REIT because they kind of got that notification. But the REIT wasn't putting as much hard money up day one. And so that was one thing that the broker mentioned to us as well.
Yeah, and on the hard money aspect, so some of you may not know what that means. Okay, so you always have a down payment or earnest money for any real estate transaction that you do. So in multifamily, you're putting money down, but usually you have a due diligence period where you're going and checking all the financials, making sure everything is what they said it was, doing inspections on the construction, making sure you don't have any issues there, and just doing due diligence, right? And then after you've done that period, then the money goes hard, right? And then it's non-refundable. With hard money, day one, we are coming in and saying, we don't need that. We want this deal. This is what we're willing to do for that. We're willing to put this money in the line for that. Now, that does not mean that there are no carve-outs for that money, okay? So, Danny, what are our three, I guess, it would probably be 3 major carve-outs that we want to have, on hard money?
So typically, if the seller misrepresents any of their financial information in their offering memorandum or in their rent roll, if they say the property generates $1 million NOI and it really generates 500,000, that would be a significant misrepresentation. If they say it's $1 million and you look through their historical T12 and it's $995,000, that's not a misrepresentation. It needs to be a significant misrepresentation. Number 2 is from an environmental perspective. So if a phase 1 study comes back with, again, significant defects to the property that require repairs above 100,000, and you can set these thresholds where maybe it's 10 or 50,000, depending on the size of your multifamily property. But that would be the second item that kind of protects us with our earnest hard money to get that back. So there's a significant environmental defect, we get that back. And the third one is, I'm drawing a blank here if you guys have it.
Yeah, it's the seller's inability to close, right? So let's say they can't close, so we're not just saying, hey, this is your money, here's a check, do whatever you want.
Right.
So we have specifics, and those, and that was discussed, in the best and final round. Hey, what does hard money mean to you, right? That was a specific question that we were asked. And so we came back and said, these are the 3 things we're going to be looking for. Obviously, if we get to the closing table and there was something on his books that we didn't know about, and so so the lender doesn't want to sell the deal because of the seller, or they don't want to fund the deal because of the seller, well, we want our money back because it wasn't our fault, right? So that's a very significant one. That was pretty, go ahead.
I was just going to say one question that came in from Jim O'Connor. Do you ever raise funds and then find the deal? I'm going to say speak to your SEC qualified attorney to get the answer to that. That would be considered a fund or a quote unquote blind pool. And that has a lot different regulations and upfront filing fees and requirements than a syndication does. So no, we do not. We always find the deal and then speak to investors about the opportunity to specifically invest solely in this property at address 123 Main Street.
Well, and I think the other thing to mention here is to kind of clarify is technically we are not raising money for a project before we actually have a project. So we never talk to the investors about us even having this project on the line until we actually have it under contract. So that doesn't mean that we're not talking to investors about investing in our various projects that may be coming up. So we're always looking for investors, and we're always looking for people that want to be able to use their IRA or other income or other cash to be able to invest into these projects. We're always looking for that. But no, we're not going to go and say to investors, hey, we might have this deal we're going to need 20 million for. Can you go ahead and fund for it? I don't know any investors that would actually do that unless there was some sort of fund that was created, like Danny said. That would be an SEC question as well. So how did we actually structure? Well, so we're going to answer two more questions as far as what we wanted to make sure we covered today. So the structuring of the deal with the investors, which I'll cover that real quick, and then I'll have you go into the financing of the deal. And then we'll wrap it up with some of the thoughts on why we feel like we really lost this deal and some of the different things that maybe we can learn the next time, if there is anything. And then we'll answer any questions that you guys might have. So first off, how did we structure the deal with investors? So I believe on this one, Danny, you can correct me if I'm wrong, I believe this one was as an 80-20 split. Was that correct?
For the deal we lost out on what we were projecting? Correct. Yeah, we were going to do an 80-20 split.
What that means is that 80% of this particular deal was going to be was going to be carved out for the investors and the amount of money that we were raising, and then 20% was for the general partnership or the sponsorship, if you will. And so that's pretty much the structure that we were doing. If you have any questions about that, let me know. It's a pretty straightforward thing.
One thing I want to add to that, it's going to kind of play into what we talked about and going into the best and final round and how can we make this deal work with the criteria. How important, Danny, is it to know your criteria exactly to your investors and your returns and everything before you go? I mean, how does that affect the best and final offer?
It's very important. Like I said, it's kind of that math equation you work backwards from. You have to have returns or an opportunity that returns what your investors typically expect. And you probably will have a very difficult time going to an investor to pitch them on a 7% return deal when you've typically done 15%, and they could probably invest in a mutual fund or a stock and earn 8% and be able to sell it anytime they want. So, you have to be very knowledgeable of your metrics and your returns before making that best and final, and then being very comfortable to say, okay, we're ready to close. Here's our hard money. I know we can get investors because we have a good opportunity at returns that our network is willing to be a part of.
Well, and I think that's the key thing about all three of us communicating when we're doing these projections, because you might change some of the numbers in the underwriting and increase the offer price, and it affects the returns. And then you kind of come to me and say, hey, what do you think we can do with the investors? Because at the end of the day, I'm an investor first, so I'm looking at this as would I invest into this deal at those types of numbers, and do I think the majority of our investors would also invest in those same numbers? Correct me if I'm wrong, Danny, but I believe on this particular deal, did we originally start out as 70-30, and then because we had to increase our offer price, wasn't that in the second round that we decided to change that split so we can make the returns better for the investors?
Yeah, absolutely. Typically when we do, again, a quick analyzer on a deal, we'll do our normal 8% preferred return at a 70-30 split and see where things shake out. But you always need to kind of play around with the numbers a little bit in terms of what that split is going to be. And so, as Dan mentioned, we're investors first and foremost. We invest our own money, our cash from our bank accounts personally in every deal, and make sure that we have an alignment of interest with investors. And so for this particular deal, and again, due to the size of a deal, when you're getting above, $30 million in asset price, that can, change the size of the returns. And so it's a lot different than, a few $1 million deal. And so it made a lot of sense for us to split it 80-20 in order to achieve the investor returns that we always look to get.
Yeah, because if you're normally putting out deals that are 15, 16, or 18, 19%, and you get this deal that you have to increase the offer and it goes down to that 14, 15%, you might want to look at, especially with this deal, we had a large raise on this. We don't want to have any issues raising the money of an investor saying, oh, I got this deal over here that's going on, and I can put it in there and I'm going to get 19%, but if I put it in yours, I'm going to only get 15%. You have to kind of balance that out as well. And so, we always want to make sure that is a flexible number as far as what that split is. And so, we don't have any problems changing that split or, having to lower acquisition fee or disposition or some of the other management fees if we have to. So that's definitely a piece there. So I want to talk about, Danny, a little bit about the financing on this deal. So talk a little bit about what we had secured, not really secured, but what we had gotten, quotes on or whatever, as far as what we were going to do with this deal, because this was a totally different one than the one we had, the other one we have in Greenville, which is the 130 unit one that you're, going back and forth, closing today, coming on and off the webinar. But is everything going good? We're still good?
Still on track. Got a few final things to do, but we've got a couple hours left in the day in terms of 3 p.m. wire deadline. So we'll be good to go.
Cool. All right. So talk a little bit about the financing on this particular deal that we lost.
Yeah, just like you're going to spend your time to go out and tour the property and do your due diligence and you do your physical inspections, a huge component to win the deal is actually having a lender that's going to give you 70% of the total equity. So in this case, roughly 30-some million dollars. You better believe it that we need to approach them early in the process to make sure that they can check all their boxes. And so what I typically do when we have a new deal coming up, I will send it to a few lenders that I have a good relationship with, and I'll say, give me a rough ballpark on it, and I need to take a call. So I'm going to turn it back to you guys to talk about the financing approach, please. Not a problem.
So basically, in a nutshell on this particular project, we kind of take it up from where Danny was saying is that we send it out to several different lenders that we have relationships with and have them give us back some quotes. This particular one, we were going to be going with an agency debt. It was a 10-year fixed rate agency debt. I think it was either with Fannie Mae, obviously with either Fannie Mae or Freddie Mac, but I'm pretty sure this one was with Fannie Mae. And so obviously these were just quotes. They're nothing finalized because it wasn't a deal that we had under LOI or anything like that. We were just in that quoting stage. And so we had a permanent debt on this one with, I think, 4 or 5 years of IO. So Danny could confirm those, but obviously he had to jump off, so that's okay. I think at the end of the day, to kind of wrap the webinar up a little bit here, I want to talk about, why we lost this deal, because there's definitely some key things as to maybe what we could have done differently, or maybe different ways we could have maybe tried to get this deal outside of, somehow getting rid of the REIT if we could. But because obviously if the REIT wasn't there, I think we probably could have gotten this deal. But I will turn it over to you. So if you have any questions from anything we talked about today, jump on the Q&A box on Zoom, type in your questions, or if you're on Facebook, you can type some of your questions in there as well. So I'm gonna go ahead and let Brandon jump in here.
So a couple things you want to keep in mind on these deals. So they're structured different ways, right? So the broker could be getting a flat fee, or he might be getting commission on the deal. That's going to affect his interest in the price going up. If it's flat fee, he doesn't really he's not as interested. Then you're also going to have sellers that are just, they're dealing with an asset manager and they want the broker to pick who the buyer is, right? They're like, I mean, these people, just pick the best buyer, right? But then you have owners that are, no, it's my way or the highway. And so with those types of owners, and Dan and I have talked about it, if you're a seller and you come up to the deal and you've got two people and one's a publicly traded company and one's a private capital firm, which one are you going to select to make sure that you get your equity out of the deal? All right, so the obvious reason that we did not get the deal was just surety to close, right? And that was just the case. Now, this is where networking comes into play. I mean, when you're in a market, that's where getting deep in the market does help, because you get to know buyers, right? And not just brokers, but you get to actually know the buyers.
And the sellers.
Yeah, and the sellers. So now they know you, right, personally, and they're like, oh yeah, you bought my other deal, or I bought your other deal, and it's close knit in a small market like that. So then it starts to get more personal, and you start getting numbers out of it. They're like, well, these guys, I've dealt with them before. So that's where not necessarily experience, but familiarity comes into play. Because I actually talked to brokers on this after this, and they saw our offer come in, and they were like, wow, they're going to get this. I mean, that was literally their response from it. But, at the end of the day, it's not their decision on this particular deal, the way it was structured. And the seller made the decision, and he made a decision for his, what was best for him. And so there's nothing you can do on that. So it's very hard, you're waiting, the 3 days waiting after you did the initial LOI, waiting to find out if you're in best and final, right? We kind of knew that, but I'm very impatient, and I want to know, right? Got my phone like ready to answer. And so, you're in best and final. So, we get it in and get the next one in. You're waiting again, and then, you're waiting, and then we get a phone call. Oh, we got more questions and this and that. And it sounds like we're going to get it, and then you don't get it, right? That can be, it can be disappointing. It can also be discouraging, right? I just spent so much time on that deal, and man, it just didn't work out. I've got these other 5 deals, but I don't even have the energy to look at those right now. I'm just so bummed out about this. That's where your determination in this industry is really going to make a difference. Okay, just it's okay.
It definitely feels like a punch in the gut.
Yeah, I mean, that was a super bummer, because that would have been a super sweet deal. I'm just here to tell you, the numbers were great, and we all loved it, and it would have been great for the investors, and it was just a great deal. But you know what? You can't win them all. And out of the majority of the deals that we look at, we do not get a vast majority of the ones that we look at. I would say of the ones we look at, and even of the ones you spent LOIs on, I would say, it's a low percentage. So, you're looking at tons of deals. You're spending lots of time on this, and that's why having a good, strong team is important. You can't do it all yourself. And I don't know how many times, I've come to this discussion about a deal with a certain number in my head, right? Or a certain idea or certain thing. And Dan's got a certain idea about it in his head, and Danny's got a certain idea about it in his head. And we collaborate, and we all come out in agreement at the end and say, yep, this is what we're going to do. And that is the benefit of having different perspectives. I'm very tangible, right? I'm the construction guy, right? I'm very tangible. Dan is very personable, right? So he's looking at, again, for the investors, and Danny is very logistical, or, numbers. So those play in well together. So make sure your team, no matter what you're doing, make sure you have a strong team. You'll hear that from everybody.
I'll say one of the things I'll mention about the REIT in this particular case, because I think at the end of the day, like you said, that was the reason why we lost this deal, was because if you put yourself in the seller's shoes, if you're going to sell something to somebody, and pretty much a REIT has that ability to close, because one of the questions we had came in is what makes a REIT so formidable when it comes to winning these deals? And I think it's the strength that a REIT has. And it wasn't a private REIT. This was a publicly traded REIT, so it had some clout behind it.
It's funded already.
It's already funded. The money's there, so they're not having to go get a loan or anything like that. I mean, the money's there, and so the biggest, that's one of the reasons why it's good to maybe sell to a REIT. Now, at the same time, the other thing that a seller has to consider about a REIT is, let's say that we're putting up 500,000 hard, they're only putting up, say, 200,000 hard. that hard day one. Well, the REIT probably is not going to, it's not going to move the needle for them if they lose $200,000 out of their entire fund if they had to move on this deal later when they got down to closing. So it is possible that the REIT could get all the way down to, a day before closing or a week before closing and basically say that they want to be able to head and get out or retrade or get a different price on it. Or maybe even they get it under LOI, but before they get to the PSA sign, they try to retrade. And that could happen, and they haven't even put up the money yet, but before they sign the PSA, they say, hey, we want to go ahead and lower our offer price or lower the hard money or whatever it is. And that might cause the seller to not sell to them. So is there a chance, is there a possibility that we get a call in a couple of weeks and they say the deal's still on the table, do you want it? Yes, that's definitely a possibility.
Before?
It has. So it happened with this deal that we're closing today, which is the reason why Danny's not on here, is that the deal that we're closing today, which is in Greenville, South Carolina, it's a 130 unit property, we lost it as well. And then after we lost it, 4 weeks later, we got a call and the broker gave it to us because we weren't even the next in line, but he knew we could close versus the other two that were ahead of us. And so he offered it to us and we took the deal. And so it's very possible. So you don't ever want to just give up on it as far as that's concerned. And any deal that you lose initially, I would suggest not constantly, but at least if you have that relationship with that broker where you're touring other deals with them or whatever, even this one, I won't go into that, but we had, even if you're talking to other brokers in the area, ask them about, tell them about some deals that you put offers on so they kind of know, and maybe they have some inside information, who knows? But always follow with the brokers that you lose deals on to see how that deal is going, to see if maybe you got it. So I think that's a very important key distinction here.
Definitely.
So if you have any questions, I don't see any more coming through. I really appreciate all of you jumping on. Hopefully you found this very valuable and very useful. If you did, press the like button if you're on Facebook. Make us a comment inside of the Zoom chat box. Let us know that you appreciated all the content we provided. I do have one question that came in, so I will cover that. And then if you're on YouTube watching this afterwards, make a comment as well. Press the like button to show us some love. Let us know you're out there. We really appreciate all of you following us, and as well as all the promotions and that you guys do even without asking. And for those of you who have joined us already and bought a ticket for the summit coming up, if you haven't, you can go to mfinsummit.com, mfinsummit.com. And check out the summit that's coming up in January. So look forward to having all of you there. We did just confirm some more speakers, so now we have 55 plus speakers. So I think it's right around about 56, 57. So I don't know for sure the number. So I know it's at least 55. So we'll say 55 plus. So it's going to be a great event and be a lot of fun. So the one question I have in here was earlier we were talking about. Daniel was talking about what the price per door, trade, in, and then the cap rate. So obviously price per door trade in is, not trade, but trade going in is the price per door. So if you're going to buy let's just make the math simple. If you're going to buy a, $10 million property and there's 100 units in it, the price per door is going to be right at $100,000 a door, right? So you want to make sure that you, in that market and around that area, obviously these properties are valued based on the NOI and the cap rate, and that cap rate is that capitalization rate. Those are all in that market. And so if you don't know what it is in a particular market that you're looking for, talk to brokers. Look at some of the reports on CoStar to see what are some of the comps that have sold in the area. Even though it's not directly based on comps, you definitely want to see, are you in the right ballpark when you're looking at that? But there's a lot of factors that go into play as far as the price per door and the comps, because you might have some deals that trade for a lower amount, but it might be because they only have 1 bedroom, 1 baths, or all studios, or whatever. You might have some that trade a little bit higher because they have higher number of higher number of rooms, like 3 bedrooms, or we've even seen some with 4 bedrooms in some of these projects. So my opinion is, if you need 4 bedrooms, you just need to buy a house. I mean, that's a little bit large for a property.
So I think they want to know what the price per door was on this property and what was our cap rate on this property.
Well, I mean, I don't know if they knew about. I can't give all that information, but it was. I don't know if you guess what he was asking because it says it's in quotes to the price per door. So
Right.
but anyway, so if you're curious about
you
that,
can figure the math out basically by the numbers we've already put out, and everything.
well, let's just say 45 million, right? Divide that by the 370 plus. We're right at about 120,000 a door on that particular product. So, which in that market was a steal of a deal. So it's actually pretty
If
good.
we gave the cap rate, we'd be getting into the NOI and stuff like that, which is confidential stuff. So.
Yeah. No, I mean, let's just if you just said it there, let's just say the cap rate was a 6, right? I'm not going to give any numbers out, but if you're at 45 million and your cap rate's at a 6, you're looking at wrong number, 45 million. You're looking at an NOI of about 2.7 million. So at that 2.7 million NOI, you're going to come up with that valuation to add a 6 cap. So obviously we're trying to move the needle a little bit and kind of go back and forth, but thank you guys. I'm going to wrap it up here. I don't have other questions. Stay tuned. If you haven't joined our email list, go to multifamilyinvestornation.com, sign up for the email list. Danny, we just wrapped it up. Any final thoughts on why we lost this deal?
I'm sure you guys kind of covered the basics about competing against a REIT and, competing against other buyers who may have previous relationships with that seller. So again, it's a relationship business. The better you can strengthen your relationship with brokers, lenders, property managers, the community of 150 unit plus multifamily owners is small. And so the more involved you can be in building those relationships, there's only so many attorneys that close 150 unit apartment complex syndications. So what I would say is build your relationships across all vendors that support the multifamily industry, and you're going to better your chances for getting deals awarded to you.
Yeah, I agree. Well, I think that's it. We're going to wrap it up here. Thank you, Brandon. Thank you, Danny, for joining us. And we will be doing another webinar next week. Not really sure what the topic's going to be yet, but we will toss a few ideas around. We have a lot of different pieces. If you have any ideas on some webinars that you might want to see, shoot me over an email, dan@multifamilyinvestornation.com, or make a comment on Facebook or on YouTube. Be glad to be able to try to create one around that. That's how a lot of our ideas for webinars come is from when you guys say, hey, would you do a webinar elaborating on X, and then we can kind of build one up around that. So hope you guys have a great rest of your day and a wonderful weekend.